wanted to click this just to show you the distance. So basically the distance from wave 2 to wave 3, that's basically a 127 point move, which is basically meaning that the VIX cannot go above 21 points to the upside. So whatever that distance is, that will basically be the maximum limit. Like I said, it's very rare that we see something like this on the market, especially the indices, the volatility index correlate so beautifully with a wave theory. Usually they're kind of pretty hard to see, but I mean, right here, seems like it was pretty good. Same thing. I mean, it played out pretty good here too. I mean, you can see that the wave count right here, 1, 2. You also got wave 3. This was wave 4, and then this is a wave 5 continuation, and then A, B, C down. So we're kind of getting that same situation right here. So we do still expect volatility to pick up, and if you do go ahead and kind of look at some of the seasonals, majority of the time, the VIX does tend to pick up a lot of volatility heading into basically the beginning of the year all the way till the March period. This is just an overall volatile time, and then there's also many things that play out. Not every year does this happen, but usually 2 to 3 out of 4 years this will take place because, again, there's the 1-year cycle, there's the 4-year cycle, the midterm cycle. There's so many different cycles, but usually when the markets do get extended, the volatility does pick up. And that's exactly what we're going to talk about today. Which many people seem to have basically been asking for is, what do you mean when premiums are expensive? And how do we know premiums are expensive? And how do you know when to buy and when not to buy? So we'll go ahead and try to get through it and see if you guys can kind of maybe get a little bit more of understanding about this. But before I do that, let me just make a quick order. I need... should be good. But the easiest thing to actually understand, and again, if I do cut off, make sure you guys do notify me. This will sadly, well, I don't think it should be recorded. I think whoever is here is going to see it. Whoever isn't,
I'll record it.
But you're here. All right.
Yeah.
But yeah, so I don't think you have to do. It's going to be a pretty long one. It's going to be boring. I don't think people are going to want to watch it again. But yeah. So right off the bat, the easiest thing to actually understand is you really need to build some basic grounds, right? Before you dive deep into trying to understand everything, building some basic building some basic ground and principle is usually the first place to start. And usually the best place to start when it comes to the VIX is just understanding what volatility means. And a lot of people seem to confuse volatility with thinking that it's always crash, and that's not necessarily the true meaning of what volatility means. Volatility simply means trading in higher than beta movement. So usually there's average beta, which if you guys don't know what beta means, beta just simply means where does the stock usually move in? Like what is the range that a stock moves in? A stock like Walmart usually has a 80 to 90 cents beta, right? Where it goes up 80 cents, comes back, and then if it goes below 80 cents, it's extended, and then it rebounds. If it goes above 80 cents, it comes back, and it rebounds. And then things trade within that range, and they call that a beta, right? It is the other people, you could also use many indicators for that too, as well, which they call the average true range, right? That's the ATR. If you're looking for an indicator, you can just literally look at TOS. You swipe 3 times to the left on your charts or whatever. We'll show you that information. It's not that hard. But that's what beta is. Beta is just basically the movement. And when we say volatility picks up in the market, all that means is that beta, just leave it outside. I'll come get it. All that means is that the ranges that you're trading in basically become much more volatile than usual. So instead of only moving 80 cents per beta, which is like per average movement, then the stock starts to maybe trade in $1 increments. And then maybe even trades in $2 increments, which means that the volatility, right, is meaning that the ranges have gotten bigger compared to the normal beta that the stock was trading in. Now, when does volatility pick up? Well, volatility starts to pick up once you violate the second standard deviation and you start heading into the third deviation. So basically, stocks majority of the time will trade in a very safe fashion, right? That's very respected, which means that maybe a stock will do something like this. This is a stock that's uptrending. All right, we have a stock that's uptrending from there, and the stock will do really well, right? It's going to go ahead and trade within this. And that's literally the beta of the stock. It's to trade within this channel. However, once the stock goes ahead and it starts to trade outside of that channel, then we can say, okay, well, the stock now is getting outside of the first standard deviation. What does that mean? Well, it means that the stock is a bit more volatile than before. Now, what does that actually do to the stock? Well, it makes the market maker, the person who basically sells the contracts to you, he kind of expands his expectation that since now the stock is trading at this beta right here, that as long as it stays into here, he's okay with it. But you're not going to make the same amount of money as you did in the first channel. So things are going to become a bit more expensive. Now, are they going to become a bit more expensive because he just wants to scam you? No. They're going to become a bit more expensive because now you're trading at a bigger range than usual. Because instead of basically you moving from, let's say, $10 to $5 and then going back to $10 and then going back to $5, the market maker thinks that it's fair to give you 100% for every $5 move, to make it fair, to encourage you to trade and invest and day trade and all that, right? He wants to make it worth your while, but he also wants to make some money as well. Not always about, oh, let's scam retail and let's get them wrecked. They want to make it fair so that people are encouraged to trade and make decisions like that. But if the stock starts to move from 15 to 5, then the movement now is $10. The market maker is only going to give you this reward one time. So when it happens the first time, the market maker will give you 200%. Remember, it was 100% for the first $5 move. $5 move down, he gave you 100% here. So I'll type it out for you. On that first $5 drop, right, equals 100% gain if you bought puts, okay? And that's basically what he's going to give you. And then if it goes up $5, right, he will give you another 100%. If it goes down another $5, he'll give you 100%. But now that it went $10, this is the first time that it's done that, the market maker is going to give you double that because that's doubled. However, on the downside, if it comes down or if it goes back another $10, so let's assume it went down $10, in this case right here, so we're assuming it went down $10, he's going to go back and give you that same movement that he gave you here, which is going to basically give you back, again, 100% only. Even though it's the same movement, it's still $10. Why did he give it to you here? Because he was not expecting that. So whenever this move happened, you outpaced the market maker, which means that you beat the market maker expectation. And once you beat market maker expectations, you get rewarded for that. And if you don't, then you get also heavily punished. So now that the stock's coming down $10, well, you're only going to get 100%. And if it goes down another $10, you will only get 100%. But then if the stock goes back $5, well, you're only going to get 50%. And then if it comes back again $5, then you will get 50%. And then once the volatility comes back down to where it started, then you make 100% for every $5 move again. And that's how volatility basically works. Hopefully, you guys kind of get an idea. Is everybody kind of getting it? I'm trying my best. I don't prepare for any of these, so maybe I should just to get some ideas in my head, but hopefully it's kind of giving you an idea of what this means. I'm going to get my water real quick, all right? All right. We're back. So that's basically what volatility means. Yeah, but that's literally what volatility is. It just means that now that the stock is trading in bigger ranges, you need a big move or you're not going to make a lot of money. But majority of the time, if the volatility is very high, you do tend to get that big move, right? So do not be shocked. However, the problem why we think we're getting robbed is because we're so used to $5 move giving us 100%. Now that $5 move is happening here, you're like, bruh, all I made was 50%. What kind of robbery is this? It's like, no, because the volatility is so high. Now, when does volatility reach maximum peak? Right? The maximum peak is actually when volatility breaks above the third standard deviation. So what is the third standard deviation? Well, this is it right here. I'm going to have to go back to the end. Need to delete this stuff. All right. The third standard deviation is once you break out the third channel, which is going to be this right here. Once you break out of it, then you have reached maximum volatility majority of the time, because now the ranges are really, really nasty. Here, premiums are really, really expensive because the market maker is expecting massive, massive ranges. So he's expecting it that it's going to go down to here, bounce back, here, bounce back. So you think about it in a basic way, it's like, how did you actually start? Well, you started trading within this channel, right? That was basically entry channel number one. You were trading in this. And then after that, well, now you had basically second standard deviation movement, which means that now you're going down to here and you're trading within this channel. So that's pretty big range. The third deviation movement is going to take you much further. It's going to take you all the way to here, back all the way down to here. And that's usually, believe it or not, usually indications of toppy markets or toppy stocks, meaning that you're usually reaching a phase of distribution, because stocks should not be trading in the third deviation in a stable way, because it's very, very hard to maintain. Now, of course, it doesn't always look like this on the charts. What more likely you guys will see is usually a stock like this, right? Where you'll basically see something like this. It's not deleting nothing. You'll basically see a stock like that. And then basically, if you try to draw your channels will look something like this. Your first channel will be like this. Your second channel will be your second deviation. This one will be all the way here. And then your third deviation will be a bit above it. All right. Why is it not letting me copy? And then this one will be all the way here. So usually what we say is, many people say, well, don't chase the stock. Well, you can technically trade it. There's nothing wrong with that. But just make sure that you're trading it a bit more strategically, because you're going to need a big enough move to satisfy you. If you basically try to scalp these type of environments right here, anything in the third deviation and above, you're going to get clapped. It's very, very tough to scalp these type of movements, because getting that 10, 30, 40 cent movement is not going to be satisfying for your gains. So you have to be very cautious. And then usually whenever stocks are trading in such high betas, and this has to be the overall market, usually the one thing that will happen is volatility, which if you guys search up the VIX, it's the S&P 500 volatility index, it will go ahead and spike. Now, why does it spike? We'll go ahead and get right into it in a second. But I think Kobe had something to say, so we'll go ahead. He has to say.
Oh, so that's why for the SPY recently, even for that first drop, you were able to make a lot more than on the second one, where today, a $3 move on SPY only gave us like 30% because of the volatility.
Oh, yeah, the volatility is getting worse. That's why. It's not calming down at all. But so the volatility index, there's a few of them, but the main ones that you're going to use is literally going to be the VIX, the VIX. Now, this is the volatility index for the S&P 500, which is the ticker SPY. If you're looking for the NASDAQ volatility index, then you're looking for VXN. So this is literally the same thing, but it tracks for the NASDAQ. Now, what does the volatility calculate? Well, like I said, it calculates the beta movement for each stock. Once stocks start to trade in bigger ranges, the volatility picks up. Why do they pick up? Because usually that's a sign of a bit of uncertainty. A lot of people get this confused and they think that if the VIX goes up, it means everything's crashing. It does not mean that. All it means is that the cost of insurance goes up. Because usually some people are scared, some people are uncertain, we don't know. People just like to be hedged during these situations. Therefore, it causes a lot of put premiums and call premiums to get very, very expensive. Now, commonly, majority of the time, what we say is that if the put to call ratio, for example, which is a separate thing, if the put to call ratio goes in this little bear town that, if you guys were here from last time, bear town is usually where there's too many bears. And usually we're very bullish on the market around these big areas. I think that the market is probably going to have a nice little pullback. This basically gives you an idea that puts are cheap and calls are cheap, just as an overall image, right? As an overall image. However, when you look at the VIX, it shows you that everything is expensive because the VIX essentially actually, in a way, is embedded in the so-called implied volatility. So when stocks start to move in a very large beta range, which is basically very large ranges, that also gets factored into the volatility. Now, implied volatility, aka IV, does not discriminate towards calls or puts. It basically pumps everything. It makes everything very, very expensive, right? It makes everything very, very expensive. So if you click on a contract, you can see implied volatility is 52%. Usually indexes only have 14 to 20% implied volatility. So the fact that the NASDAQ is trading at, 52% in the money shows you that those contracts are charging you a 50% premium to make a bet on it. And if you go out of the money, they're at 49%. So there's less implied volatility out there. Here it's 52%. And if you go, the more safe you try to be, the more they're going to charge you. So you basically, what this does is it encourages people to take on more risk and go deeper at the money. As you can see here, look at in the money puts. In the money puts have a 53 IV, which means that they're really, really expensive. Out of the monies have a 59. So the puts are much more expensive on this side versus the calls, right? So if you want to go ahead and have safety, they're charging you more for the puts because the market is so bearish. However, if you're trying to go long the market, if you're going in the money, they're charging you a premium. And if you go out of the money, well, they're still charging you a premium, but it's not as much. At least it's really not that big of a difference, but it's not as much as in the money because, again, you're considered to be less safe out there. So, again, when volatility spikes, all it essentially means is insurance costs more, which then ends up with premiums costing more in general. So VIX goes up, options become very expensive. When the VIX goes down and it chills out like these areas right here, you can see 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 right around here, around here, around here. It means puts and calls are very inexpensive and they're at fair value. Not always though, right? Not always. Don't take this for granted. You have to look at the PC. Only during the PC, only if the PC is also correlating with this does it matter, which majority of the time it does tend to. So if the PC is really, really cheap and, we're like this right here, then it means that calls are very cheap. But if the PC is really, really high and we're chilling here, it means puts are cheap, but calls are not, right? No. It means puts are expensive, but calls are not. So it basically goes back and forth. But usually what we like to see is we like to see a flat volatility index with a correlating, basically, PC. So if we're bearish on the market, we want to see the VIX not so high, and we want to see the puts the put to call ratio very low. And if we're very bullish on the market, we think the market should go up. Well, we want to see a high PC reading, and we want to see a very low volatility index as well. So when volatility picks up, things become very expensive. When volatility crashes, things become less expensive. And that also means that you get more money for the range that you get. So if the stock is trading, let's say, one more example, let's say we're trading here, and the SPY goes up $2, you get 100%. The SPY goes down $2. Let me actually do it so you can see it chart by chart. So let's say right here. Okay, so you guys will get to see a good example. This is right here. The VIX is really low. Everything's cool. Your stock goes up, you get 100%. Your stock goes down the same range, you get 100%. Your stock goes up 100%. Say like $3 again, you get 100%. The stock breaks out and goes another 100%. Well, as long as it stays within that $5 and it stays here, then you get the same 100%, same 100%, same 100%. Now volatility picks up and the stock goes up almost 16 or whatever. Well, now you're going to need big, big ranges for you to make that same money. To make the same as you made here, you're going to need this big of a range for you to have it. Because again, volatility is very, very high. And pretty much all there is to it. It's really straightforward from here. The same thing for the VIX. Yeah, chat mod's actually pretty important. So these change year over year dependent on the market. So usually if you were here in 2018 and 2019, we considered that a VIX below 14 is considered to be consistent volatility. So we said anything below here. This was something we used for basically from 2015 and before. So we say anything below 14 is considered to be a very healthy, non-volatile market, right? And that's only if you were here from a while ago. Back in 2010 and 2011, we said that anything below 24 was considered to be a non-volatile market. Here in 2020, in 2022, and 2021, we say that anything below 20 is considered to be a normal non-volatile market. So below 20 for the VIX, okay? So as long as we're below 20, which is basically around here, we would say that we're in a very low volatility market. And usually everything is pretty cool and chill. The PC, however, this also changes, but not so much. Currently, this is what we have, but you can see it does change before as well. So usually you just have to adapt to it. It's nothing too crazy. It's nothing too hard. We're basically taking the lows on, how is the market expected to be performing, and what are people basically considering as maximum pain, and what are people considering as maximum puts, basically for both up and down, and you kind of get an idea. But right now, currently, anything below 0.45 is considered to be a very bullish market where a lot of people are getting calls. Anything above 0.69 heading into the 0.8 is usually considered to be a bit bearish, and then aggressively bearish above that. And then the balance zone is usually 0.69 to 0.55, as majority of people like to kind of basically arrange it. Before, it used to be a bit higher, but again, you have to remember, before COVID in 2008, in 2011, 2012, 2018, we've had our fair share of fear where everybody always felt like they need to be hedged because of the nightmares of 01 and 08. So everybody was always just kind of like in panic and in fear. And just recently did people like calm down with the hedging and all that crazy stuff. But yeah, hopefully that makes sense. Anybody else have any questions? So here's an interesting thing. If you were to buy LEAP contracts, when should you buy it? This is the dangers of why I tell you guys, do not buy the dip. Do not be an idiot. Do not buy the dip. Because what a lot of people do is they find that the market has went up, and it went up, and it went up, and then it crashes. And the volatility starts to peak, which means that this volatility right here is adding extra money to your options, to all of them, the calls and the puts. Once the volatility crashes, it takes that money back. Okay, hopefully you're following along. When the volatility goes up, you get hashtag $ plus $.
Zach, I think you're muted. We cannot hear you. Zach.
How do I keep getting disconnected? I don't get it. It's always on. I'm good now, right?
Yes, sir. You're good. You're good.
I got to change the settings on the microphone. It keeps connecting to the other computer. It's got to be another, or the other monitor that I'm using. Let me just turn that off, I guess. All right. Hopefully I don't get disconnected. But what it basically tells you is that as the VIX starts to go up, there's money being added to your contracts, calls and puts. So what does that mean? Well, it means that if you have a $100 contract, as the volatility goes up, you're probably going to gain $6 plus 7 plus 9 plus 8, even if you're in the wrong direction. Even if the thing's tanking against you and you had calls, your contracts are going to become a bit more expensive. or they're not going to lose as much value because there's some money being added to it. What do you think happens when you reach the top? All that money is there right there. All of it right here. And that's how much your contract is worth right here. And where's the market? The market is all the way down here at the bottom. And you go in and you buy the dip like the champ you are because you see a demand zone. The volatility gets crushed. The SPY bounces a little bit. You make a little bit of money, right? You make a little, maybe point, let's say you add 9 or 10 more. And then the market pulls back to kind of rebound. And then it breaks out and the volatility gets crushed. And then you wonder, why are my contracts negative, even though we're at a new high and I bought the dip here? Your contracts will lose value. The contracts that you bought here will be much cheaper than where you bought them here because the volatility crashed. The volatility came down. The VIX came down. This money that you got added gets subtracted now. So it goes back to its original value, which was basically $100. So when you bought it here, you paid $150 and you gained $10 on the bounce, but then you lost 40 from the volatility. Now you're negative. You're net negative. You're down 30% by default, and you can't do anything about it. Doesn't matter. So now you need the SPY to really, really go high to make it worth it. So what do we say? We say do not buy the bounce, buy the final recovery. It is much better that all of you get into the habit of letting things bottom out. You're not responsible to call the bottom. Nobody's telling you to call the bottom. But you have to wait enough to make sure that the contracts are not gaining free premium that will be taken away from you. When COVID hit, I knew where the bottom was. We all knew. Every smart guy knew exactly where the bottom was. However, none of us bought. None of us actually bought a damn thing because the volatility here was complete shit. Meaning, I actually, all right, just to give you an idea, the contracts that I wanted to buy for January 21st, for the January 15th, some of them were worth 8 cents or 9 cents, I think. It was really, really cheap at the time, right? They were worth 8 to 9 cents. The ones I wanted to buy were around 12 to 15 cents. They were 12 to 15 cents here. By the time the SPY was here during April, they were worth 3 cents, even though it rebounded 35% from the bottom. So they lost 80% of their value, even though they're higher. Imagine buying calls all the way down here. You thought you were smart. And this market, the stock, the S&P 500 went up 25%, and your yearly contracts lost 25 or almost 80% of their value. Is that not fucked up? You would be pretty mad, huh? You're like, oh, you called the bottom. Why? Look at what happened to the VIX. The VIX got completely clapped. Look at the VIX from here to March. From top all the way to April. It was right here. The VIX lost 50%. So all that value of IV, 50% of it got cut off of the premium, which was a huge chunk of it. A lot of contracts that were worth, $200 had almost $170 of just literally IV. They were just literally that jacked. It was that bad. So you don't want to get caught up in these type of situations. That's why I'm telling you right now, do not be an idiot. Do not rush. You do not have to call the bottom. God has gave us this blessing where he says you don't have to call bottom because there is no need for it and there is no benefit. So now you're basically being told you can take less risk and be rewarded better than if you would have taken more risk early on. That's a pretty good deal to me. So where would you want to buy? You would want to buy when the markets have eventually came down back to a less volatile area. So usually what happens is the market will come back, it will tag this 20, it will bounce, and then it eventually slopes down. Once it starts sloping down from here, then you want to buy. Once you're below 20, then you want to buy. And does it mean that every contract is going to be cheap? No. Some contracts you might miss out on 20, 30% profit. Some of them you might get 30 to 50% discount. It just depends on what your play style is and how long you go. If you're going to be like me and you want to buy, I want to personally buy the 2024 calls and the 2023 for the SPY, we will go ahead and wait until the VIX is below here. I don't care what the price is on the market. Doesn't matter. The S&P could be at 500 again. Who cares? Nobody cares. What matters more is you're not paying too much premium. And majority of the time, if you have bought in any of these areas, you have performed pretty well compared to the idiots who try to be smart and call the dip. And this is only for options, of course. This is not for equities. If you're trying to buy equities on the dip, then be my guest. Go ahead and get yourself involved. But it's pretty straightforward. So for those of you that are trying to maybe buy some LEAP contracts, just be very cautious. We believe there's one more pop on the VIX, and that's when your premiums are going to become very cheap. And if you want to see some examples, just look at recently September. Go look what would have happened if you bought the dip on December. Would you have made much money? Or go check what would have happened if you bought the dip right here, because usually the topping VIX is usually the bottoming market. So what would have happened if you bought calls right at the bottom of the market and the VIX just got crushed? Will you be profitable? Go and test it out. To do that, just go on Thinkorswim. You guys know Thinkorswim? How many of you guys know Thinkorswim? Right here, go on Thinkorswim, log in, and go ahead and add. Go and click on the top right corner on demand and see if you can run it back and see what you could come up with and what kind of results you would get. But yeah, basically you're getting robbed, and they didn't even leave you. Well, they leave you the underwear. Just what good is the underwear in the cold? Heartless. Yeah. Everybody understand this? Everybody cool?
Yes, sir.
Well, the reason we couldn't get into long term is because there was literally nothing that we can do. The VIX was not, it's not really the VIX that was really the problem, it's just the market. You cannot buy LEAP contracts. LEAP contracts were created to make longer term bets. They were not created for me to buy today and sell after 2 weeks. Even though I can buy a 2023 call and make 100% on it, and then after a week and then call it a day. But that's not the whole reason to why they were made. They were made for you to buy during correction periods in the market. And that's usually where they shine. They do not do pretty well on just regular pullbacks. So it's a bad idea to buy LEAPs right here, especially if you think the market is going to crash. Why are you even buying LEAPs? Just trade the volatility there. Pointless. So we were expecting that there was going to be a crash either this September or right now. That's where we expected the bigger pullback. We wanted it to happen last year on February, but it didn't want to because the rotation was just so bad in all the indices, so it didn't happen. It did happen for the NASDAQ. It didn't happen for the S&P, so that kind of killed the point. But until that happens, which hopefully it is here, then it means you can buy the dip here and actually make money off of it because, well, you can hold these for 5 to 6 months, which is what LEAP contracts are meant to be used for. They're meant to be used to be held for 5 to 6 months. They're not meant to be held and sold after 2 weeks. If you want to hold something for 2 weeks, then just get a monthly contract. Why are you getting LEAPs? So that's the whole purpose of them. And you need volatility to really, really spike and then collapse to really reprice everything and make things very normal. We have to see the volatility comes down. We're thinking we still got like 2-3 weeks. There's going to be a W formation. Every correction has had a W formation to it. There's always a, what's it called? A drop and a bounce and then a drop. Whenever that happens, it doesn't mean that it has to be a perfect W, right? It doesn't have to do this like everybody thinks it has to. No, that looks like a W. A W means that the options perform the W, not the stock. Stock, we don't care. We need the options to come down, bounce, and then come down. Even though the stock hasn't went as low, the options come back to the same price. So if you would have scooped them up here, you basically would have been clapped. Even though the stock is higher, they're at the same price. And we get to scoop them up in this phase. We're not going to perfectly buy the bottom, but we'll buy it somewhere in this range. Even though the stock is high, we're paying the same premium. So what was the rush? What was the rush of buying here? I don't know. Oh, but it was cheap. The stock was cheap, not the options. It's not how options work. All right. And it's not because of theta that these lost value. No, it's because of IV. All right. Yeah, options are pretty dangerous, man. You guys will clap yourself. The problem is people think that options are all about buying the dip and getting the perfect price. Options are all about, you got to think about it. They're a speculative instrument as a whole. So if they're all about speculation, there has to be something else that's really pricing them in. And there are some heavy derivatives behind them that make them function the way they are. And that's literally market maker expectation and volatility. When volatility and market maker expectations go up, then it usually means less payout. And when market maker and volatility go down, it means usually the payout is pretty good. And that's why if you know anything about the straddle, you guys would have noticed that doing the straddles, before where the market trades in such small ranges was so good because, well, you can make so much money very quickly. Like think about the times some of you saw the market like literally go from 10, 15 cents to $1 basically in like 1 hour. You're like, oh, I wish I would have helped. But now, I mean, you look at the SPY, look at the SPY. The SPY has basically went from 440 to basically 430. That's $10 range. And do you think the options went up and down 1,000%? Probably not. But we can check this. I mean, let's say the calls. The calls opened at 356 and they went to they went to 356 high. They closed at 121. The low is 27. So these lost 90% value. But what about the puts? The puts, if you woke up in the morning and bought the 430, right, which were these, you can see they closed at 367. So these closed at 367. They went as low as 117, and the highest that they went was literally 440. That was basically a rock bottom. So you think about it. If you nailed the top perfectly and you sold the bottom perfectly, the best reward was 300%. Assuming you nailed everything, which is damn near impossible because how many dips are you going to buy before you get slaughtered? So before, if this was $10 a month or 2 months ago, you would have made at least 4,000% gain on them. But because the volatility is very high, it's a very tough market. Any composing? Yeah. Any more big words? Vincent will scratch it. I'm trying to read. I'm like, oh, what's going on? But yeah, it's a pretty easy thing. I know it sounds complicated, but it's actually not that hard. All right, it's really not that hard. Now, here's some things that you guys can keep in mind. Okay, for those of you that are not used to the market. If you're new to the market, one thing to keep in mind: average volatility for the S&P 500 is usually around that 18 to 25%. Anything above 25% considered to be a volatile market. And this also applies to the NASDAQ and the Dow and the Russell. So they tend to have very low volatility. All indexes, all ETFs as a whole, including ARK and some of the biggest other ETFs like the Vanguard and some of the other ones, they will have a volatility reading of 18 to 25%. Mega cap growth companies like Apple, Microsoft, Facebook will have an average volatility of around 32%. Okay, something like Apple, if you go and you check it, it will usually have a average volatility without volatility. Right now it's crazy, but average volatility on calls and puts will be around, and we're talking about in the money, right near it, usually will be 32%. Apple has 116% volatility. That's 4 times the average movement. So whatever Apple is moving before, you need 4 times that movement to make the same amount of money. Okay, that's really, really sad. Small caps. Mid-cap companies usually have a 40 to 60% reading, depending on how hyped they are in the era that they're in. Average is usually 40% to 45 to 50% to 60 in some cases. Small caps, whenever they do get going and they start popping off, usually volatility is over the roof. But usually you would want anything below 80%. But just know anything above 100% volatility, anything above 80 or 70%, pretty bad. You should be very, very cautious. Okay, don't get fooled into them. Sectors and indices also very similar thing. They usually will have a 20 to 25 to 30% max on the IV. So these indices so far, they seem to be the only ones that haven't priced in a big movement. So they're pretty balanced, and that's because they haven't tanked as much. I mean, you can see XLP has not tanked much. I would bet maybe somebody like XLK has probably taken the beating down the. Yeah, this one's kind of fell off a bit off the cliff, but it's really not even that bad. But I would expect somebody like XLK who's had a bit more volatility to be at a higher IV. So, yeah, this one is at 63%. So it's only XLP that's pretty cheap. So if you're looking to make some money and on something that hasn't dropped, XLP might be the go-to. This one still has a bunch of the premiums are not jacked yet.